Welcome back to Good Returns. I'm Matt here with Garrett. We've had 1 week of decline. Looks like this week is flat. We're arguing before the show. We're getting it's either up a little, flat, or down a little. I say it's up a little. Inflation on the headline CPI number did hit a 36-month high. We've got a Fed meeting next week. It's going to be a popcorn eating event for sure. Very, very closely watched event. And honestly, there's a lot to feel good about underneath all of this. Week after week, we're not smoking hopium. There's some good structural changes that are happening in the market that are increasing my positivity and my confidence.
Oh, that's a very spicy take for
it's the right take.
Like this one.
It's the right take. We're going back up and up, it appears. There's also a planning room today I think is going to be very interesting, one of the most useful conversations that we've had on this show, because if you've been watching your account for the past 2 weeks and feeling that familiar tightness in the stomach with the ups and the downs and the backups, we've got something very important to say about it to keep you focused and to keep you on your path to success in your wealth building, retirement planning, and income planning.
Yeah, before we get into that, quick note, as always, everything on Good Returns.
No, don't worry about that. Just get right into it.
Everything on Good Returns is for educational purposes only. I don't know why this flipped. You used to do this, not me. Nothing we say is personalized financial advice. We're here to give you context and help you think more clearly. And we may or may not be your financial advisors. If you have questions about your own specific situation, we would urge you to reach out to a professional. You can certainly reach out to us. We'd love to have that conversation, but let's hop into it.
Yeah, let's do it.
So like you said, we have the market down, flat. We'll call it flat. We'll split the hairs. We'll end flat today. The market is open. It's the morning. So bearing some sort of weird event, the market for the week will close
we
flat.
eat weird events for breakfast around here. That's like, if you've been paying attention to anything in the recent past, it's
weird.
It's a great time to be alive.
Is it?
Entertaining
like that way.
time to be alive. It depends on the outlook in life, really. You can choose to be entertained or irritated.
That is true. Well, either way, we had a down week last week, maybe a flat week this week. But here's what we want to really kind of talk about. The recent winners, which were the tech sectors, the semiconductors, the mega cap growth, they are leading the pullback. And so that is directly related to what we talked about last week. It's kind of interesting that, we're seeing that.
Yeah, leading the pullback. In the meantime, we have value small cap holding.
Mm-hmm.
Again, this is what we would expect.
And again, it's not that you're going to not experience losses or negative returns or whatever. You're just, the diversification aspect of it is to help the portfolio experience less of that downturn than these really high octane sectors have been experiencing. Because you get, just like we said last week, the way high up, and then you get the pullback, and it works both ways with the volatility.
And it underscores the case for you're not investing for this month. You're not investing for this year. You're investing for decades of compounding your wealth, being able to enjoy it, get income off of it, do the things that you want to do. And so, this is just really underscoring the case for proper allocation that can be well positioned to take advantage of those rotations if and when they materialize. And I think we did see a little bit of that rotation continuing, which has been the story of this year, really. And the volatility has muted the impact of that rotation, but it is not breaking down. It is continuing against all odds. For sure. And then we had Treasury yields ended the week lower, even though the CPI print was high. Why is that? Oil down 6%. It's still down more today. Bonds rallied longer. Maturity bonds led that rally. Commodities were pushed lower. And then we saw Bitcoin not only stabilize, but begin to rebound.
Yeah,
a little bit. Very interesting things going on.
That was a wild ride.
That was wild, and just some very interesting things going on there. With a few technicals that again, very, very interesting. A lot to unpack for sure.
We can move. It was an interesting conversation to see happen, especially in light of what we talked about last week in the show with the concentration and all that kind of stuff. So it played out in like a week, which we weren't really expecting, but it's interesting that it did. So let's get into kind of the three things that we're looking at, kind of that matter most for this past week.
Well, if you'd call it a pullback, it's really more of a roller coaster ride. It wasn't really a pullback because again,
depending on what sector you were exposed to.
That's true, but you had S&P, Nasdaq enter June at all-time highs after a rally started late March, significant rally. Then the 2 weeks of either flat or losses, depending on which index you're looking at, is to be
which website you look at.
Yeah, it's to be expected. It's just part of the market digesting what it does. The VIX is very calm. That's what measures volatility. Credit spreads have not blown out. That measures kind of your implied risk. It's a pause for sure. Definitely not a breakdown. This is what you would expect to see. These types of past 2 weeks is generally what you expect to see in a healthy bull.
Yeah, you kind of alluded to the more interesting story kind of happening underneath, but we spent a lot of time last week in the show talking about how narrow the rally was, really specific handful of tech stocks, and they mostly are carrying the market while the rest of the market kind of lagged. And so this week we saw once again that the dynamic kind of reversed there. The same concentrated names drove the index down, and the rest of the market's kind of holding it up. But you're seeing the fluctuation in those indexes like the S&P because these companies have such a large weighting in those indexes. And so that's where you get the differentiation between, the market cap weighted S&P 500, which everybody knows about, and the equal weight, which is...
Yeah, and it's the gift that gives, but it's also the SOB that takes from you, that market weight, especially with how incredibly concentrated we are. Yep. 10 of the 11 S&P sectors beat the index this week. 10 of them.
Mm-hmm.
Think about that. So you had the index down, but the average stock in the index was doing better than the index itself. This is, one of the reasons we like to be allocated more towards the equal weight than the market weight. And people can argue against that, but for us, as it pertains to long-term planning and using an anchor in the portfolio, it doesn't mean you want everything in that, because you don't. You want to pay attention to the rotations. You want to pay attention to the momentum indicators. You want to pay attention to things that can give you alpha over time as well, with a good structured plan and how that's executed. But it's good to have that portfolio anchored, we believe, in this way, because healthy bull markets and healthy economies are going to reward the average stocks sometimes more than just the market-weighted leaders, and especially with the productivity gains that we're seeing. So the math of concentration, of being so concentrated, which S&P replicators are in the market weight, are really becoming essentially a stock sleeve of around 8 to 9 stocks.
Meaning they try to replicate the performance of that index without being as exposed.
Because you can't buy the index, right? You got to try to replicate it. Well, you can't buy the direct index, like you can't so you have to replicate, and then there's sometimes a lag in how it's replicated. But the point being, significant concentration that works in reverse as it does to the upside, and that's what we saw where the biggest names fail. They drug the headline number down, but if you're allocated in a different manner, you may have very well seen your portfolio up while the headline number is down.
If you were in Cracker Barrel, you saw it go up.
God. So that's the story of these last 2 weeks, and it's the story we started the year off with, and we're coming back to it.
Nice round.
The trend is holding, and it makes sense that it's holding. It doesn't mean, I honestly believe, if you look out over a decade or two, these mega caps are going to be even more mega caps. It's going to be a wild ride to get there, and they're going to play a role in everyone's retirement in some, shape, form, or fashion.
I mean, they do.
You're
already.
Yeah, but you're going to want to balance that, because just as well as I do that as these productivity gains continue to manifest into the economy, you're going to have just as big, if not a bigger run in your other companies and your other stocks. Because these people, these hyperscalers are at these valuations because the demand to build out the infrastructure is so insatiable and so high. So once that begins to materialize, you have to ask yourself, okay, they've built it. Who will come? Who's going to use it? The people that are going to use the AI and they're going to use the tokens are the ones that are going to be delivering productivity gains, and they're going to be making enormous amounts of money. So that's where I believe the market's going to start shifting over this next year, maybe 2 years, is from looking, okay, we know NVIDIA has insatiable demand. It's mind-boggling. In fact, I believe it was Goldman yesterday, put out saying that most analysts have it wrong on CapEx. They're underestimating AI CapEx. They expect it to exceed 1.1 to 1.2 trillion in a year, next year or the year after. So that's not like, okay, it's 700 billion this year and then another 200 billion and then 100 billion. That's a trillion. No. It's 700 billion this year, 800 billion next year, 1 trillion the year after. So now, again, you have to ask yourself, these companies are spending all this money for somebody to use the product. And it's not for you and me to go on ChatGPT and ask which SPF sunscreen should I use, right? It's none of that.
What a specific example.
You know, I have not done that, but I can imagine.
Sure about that?
Which brand of SPF doesn't, which brand of sunscreen stays on the longest? I got my great value is, 7.5 minutes. Then I got my, or equate or whatever.
Yeah. Got it.
You got the point.
I got the point.
Someone is going to use this to make an enormous amount of money delivering productivity gains to the real economy. And those are the stocks you have to keep an eye on. That's all I'm saying. We can end the show. It's over.
Yeah. Okay, well, that's been good. No, just kidding. Yeah, so, I mean, all that to say that it's the other parts of the market are holding up relatively well. It is a healthy sign. Like you said, it's not a broad loss of confidence in markets overall. It's not, this would be expected. It's a recalibration of what has become the most crowded trade. And we'll go back to the Cracker Barrel example where they are talking about deploying AI in their restaurants and their stock price is up 30%. We talked about Allbirds doing the same thing, pivoting to an AI play. Their stock's up 800%, So it's this kind of paradigm where you have to balance these things where you have companies like NVIDIA and then companies like Cracker Barrel or Allbirds.
And Cracker Barrel may have the last laugh in that whole thing. I mean, you just have to see what they're going to be using AI. What does that mean?
What does it mean?
How does it translate to the bottom line? It's funny. You chuckle, but they may be the ones laughing all the way to the bank. I mean, me
assuming
and
they can get people back in the restaurants, I guess. Which I mean, they did surprise to the upside with revenue. So maybe
it's very interesting. If you just most things in life you can see happening, and get a good feel for it. So if you're a frequent visitor of Cracker Barrel and you start seeing the changes of things, you may say, oh yeah, that makes sense. But even aside from that, just think of everything you do in life where you interact with other people in a business manner, whether that's shopping, whether that's lawn care, whatever it may be, anything you can imagine, and just think about a point of frustration that you personally have in that exchange, in that experience, and start trying to identify how can that frustration be solved? What could that company do to make me happier and make me spend more money or lower the prices so I'll buy more of the stuff? And AI has an answer to all of those. And if they can capitalize on that, they're going to make a lot of money. But, back to what you were saying before the Cracker Barrel, I mean, for people watching their accounts, the experience on this week depends a lot of what you own. And this is where you really have the difference between your 401k and your IRA. Maybe your stock account and your IRA. A diversified portfolio did not experience what that S&P portion, your equity portion portfolio experienced. If you were concentrated in large cap tech, you felt it. So, last week we talked about how diversification helps you on that downside, and it doesn't mean you lower your target long term. Because we're big fans. We want to diversify, but that doesn't mean we want to diversify into a bunch of boring, non-return generating, non-alpha generating assets. We want to be diversified so that you have the greatest chance of hitting your target with the least amount of volatility in the long run. And this week showed that protection is showing up, it's working, and that's a really good thing.
Yeah.
Because you can feel, first of all, when you're sitting down and identifying what return you should make, it has to be, okay, how much am I earning? What's the difference between my outgo and my income? How much can I save? And what's my time frame? And I can figure, okay, I need 10%, or I need an average of 12%, or I need an average of 9% or 8%. You have to identify that first, and then you want to have a framework that allows you the greatest chance to hit that with the least amount of volatility and hopefully surprise on the upside, right? If you're targeting 8 or 9, that's what we want to target. But, really we may actually aim for 11 or 12. We want to surprise to the upside so we can protect against inflation even more so and then give you more wealth. But that's where you have to really dial in, what do I need? And then focus on that, and do not worry about, NVIDIA did this, or, Apple did this over this period. This is a reason we were speaking yesterday about a lot of the complex insurance strategies that are out there that are used a lot for high income earners to have an additional kind of tax sheltered approach to things. Once they kind of have maxed out their 401k and they're not eligible for Roth IRAs, or even if we're doing the back door, it's only $7-8 grand. And you look at the assumed and the non-assumed rates of return and what the historical averages are. These types of strategies are extremely popular with high income earners. And what are they targeting? 8, 9, 10%. They're not targeting, meme coin or penny stock level returns. They're saying, okay, I'm gonna get to my 2 million target for this bucket of money over 15 to 20 years. And these are my assumptions. And it's not pie in the sky. It's that discipline of executing, and they know the return they need, and that's what they're targeting to get it. So all that being said, rabbit trail,
a lot of it's psychological too, though, because if that angle requires something from you. It requires steady, disciplined investing for a period of time, usually 20 to 30 years, of consistent investing, different amounts, I guess. You could lower it, you could raise it, whatever it is. There's a baseline contribution that you need to make, and you have to do it over a certain period of time.
Yeah.
The other side of that coin is the meme stock stuff, and where you put, $1,000 in and it becomes $30,000. That's the appeal of that sort of, that sort of trade. And it's, if you see your friends doing it, there's a lot of people that made a lot of money in GameStop. If you see that happen in real time, you're like, man, why can't I do that? And it just completely bypasses all the people that you're walking around and that you interact with on a daily basis that maybe are in their 60s or 70s who've spent their whole life saving. Now they have a big nest egg, and they have what the other guy has. They have it maybe later in life, but you still end up in the same place.
Yeah, well, to be disciplined in that approach, you have to show gratitude to your past self, so that your current discipline is always pushing things forward to your future self. So what I mean by that is that, let's say you're in your 401k, you're up 10% on average over the last 3 years, but then the guy sitting next to you maybe is in, let's say he's in a sector heavy approach and he's up 13%, right? And you say, oh man, that's more.
Or he's in the company stock.
Or maybe he's in the company stock and he's up 14% over that period, or whatever it may be. You see a difference and you start thinking, the correct approach is to say, I'm grateful that I'm in the position to worry about my return. I'm grateful to my former self, my past self, for saving, so that I have these thoughts in the first place. Because if you haven't saved anything, it doesn't really matter whether it's 20% or 30% or 0%. It's irrelevant, right? 30% on $100 isn't going to change your life. It's just not. So what you have to do is say, you know what? I'm grateful that I'm in the position where I'm worried about my $300,000 401k because I've saved, I've been disciplined. I'm grateful that I'm asking these questions about, should I be targeting 14, or am I on track to where targeting 10 is fine? And then from that, treat your future self the way they need to be treated by seeking help, momentumwealth.us, or a trusted advisor to build a plan to hit you with those targets. And that's what we do. We look and say, you need 10.5 is what you need. Let's aim for that. We're going to try to exceed those expectations, but let's give you a good risk adjusted opportunity to hit the targets you need. And don't worry about everybody else. You worry about you. And that is a recipe for success. We've seen it time and time and time. We've been doing this long enough to have witnessed these strategies work. And it's the approach is unique. The strategies are disciplined, data-driven, but at the end of the day, we have already solved for all of those things. There is no magic but time and discipline. It's the only magic that exists. And time is your friend. Everybody thinks that time is like, the devil. Time is the disease you can't cure, but time is your friend. It absolutely is your friend in investing. What were we talking about? CPI, I believe.
Well, we hadn't started talking about it, but that's the next section.
Tell us about CPI.
Well, you have consumer prices. We'll just hop right into it. Rising 4.2% year over year in May, fastest annual pace since 2023. So we are genuinely talking about an elevated headline number. It's just
but we know, and I thought this morning about getting one of those mason jars. I think I have a couple of them in storage or something, like the antique ones.
Yeah.
I think I have some somewhere. Anyway, and getting a stack of $20 bills from your account. And every time either oil or oils related to CPI comes up, you have to put it in the thing. So I may start doing that.
Yeah, go ahead. Sure, go ahead.
Energy, 60% of the increase was energy. So we know this. Gas up 7% May alone, nearly 40% over the past year. Strip out the volatile elements such as energy and what's called core inflation, which is what really the central banksters like to pay attention to.
Are you coining a new phrase here?
Yeah, and the picture looks very different. 2.9%. Still a little elevated. Monthly core reading at 0.2, which actually came in below expectations. So the housing costs, which are a big and slow-moving part, continued to ease. That's the structurally sound part about how the CPI reporting is going to be changing over the next year, is you have housing, which drove so much over the past 24 months of CPI, is on the downslope. And as long as energy follows its course, which as predicted it is.
Sometimes week to week. I mean, it's just you get a deal, you don't get a deal, you get a deal, you don't get a deal, you get it, back and forth.
Yeah, no, but we're down for this is, if you look crude, West Texas, we're down almost 27% from the peak. It's a bear market.
What's it at right now?
86.
Okay. Yeah. So I mean,
86.
you're not. Yeah. I mean, it's just it's a frustrating situation all around. There's no doubt that the gap that we're seeing between the headline and the core is probably about as wide as it's been this cycle. So it definitely speaks to that. Oil stuff, all the Iran conflict and all that kind of stuff is really weighing heavily on this aspect of those metrics.
It's also a lesson in how difficult it is to trade on headlines. Imagine how many people piled into oil at 110, thinking it's going to go to what they thought it would go to.
I mean, there's a lot of people that thought it would, and it still might. I mean, we're not out of it yet. We're in the middle of it. There's no telling what happens with it. I mean, over the long term, I think it is down, but long term is months to years, not like the next quarter.
I don't know. I think the end of next quarter will be in the 70s.
Well, you heard it here first.
And into the 60s by the end of the year.
Yeah, I mean, I've seen a lot of that too.
Yeah. Which is crazy. That'd be a 50%, call it a 50% decline peak to trough. It's crazy. It's going to be very interesting. The implications of what that means is going to be digested over the next few years. And it could have far-reaching implications that we're not quite aware of yet, positive or negative.
Yeah, but the greater thing that this leads to is what the Federal Reserve does with this number, because that's what they look at, and they've got this target that they've had for years, which we're nowhere near, according to the headline numbers. And so how can you square those two things? That's what I'll be really interested to see what he talks about when he gives his first presser, because it's an interesting place to be as a new incoming Fed chair.
It is, but I wonder if the change in communication is going to be impactful to the markets. Because I think,
I think they're going to want, especially when he does the question and answer section, he's going to get a lot of questions about it. He's going to have to figure out a strategy to answer it.
To me, the honest thing is that central bank can't control oil. And is it the job of central bank to determine whether or not oil producers should be compensated for pulling the resource out of the ground? Or should we, slow the economy down with higher interest rates to force people to not use oil? And then how does that actually structurally make oil more expensive than it otherwise would be if you reduce exploration and you reduce output for a short-term problem? Does that mean structurally we're paying more for oil in 2 years than we otherwise would be? These are very complicated situations. And then you had the jobs report that came out. Headline was very strong. Employers added 172,000 jobs in May, more than double what was expected. Now, prior months were revised up by 93,000 jobs. So we had a beat in May, and then they came back with a prior month's revision adding more. It's very interesting. I don't know what the inside of that.
I mean, when you look at the gains, they're kind of concentrated in a handful of industries. Long-term unemployment kind of remains elevated compared to a year ago. Wage growth is cooling year over year. If you look at that, about 3.4%. That's actually kind of constructive for the inflation story, actually, because it suggests that wages aren't accelerating in a way that would add to the price pressures. But they have to balance those two things. We've talked about the Federal Reserve's dual mandate in the past, and it's bears repeating here that they are looking at price stability and employment. It's not just one or the other. They have to balance these two things, which goes, even further into him having to make a decision, or the board together having to come to a consensus about what to do versus what to do with rate hikes versus rate cuts, and if they do anything, or if the status quo is just to not do anything.
Yeah, and that very well may be. We need more data. The consensus in the long run, nothing has changed the downward slope of rates. Over the next 2 to 3 years, that is pretty much set in stone. How we get there is what I guess this inaugural meeting will illustrate. It's very interesting.
Do you think he'll have a comment on the valuations in the market?
No, hopefully that's all over with. That's all over with for sure. It's a very weird. We pay attention to the long run. We try to identify long-term trends. We really do a good job of creating structural portfolios that have an enduring opportunity to compound wealth. And it does become, I don't know, I'd want to say silly to be worrying about what these people say every month or every other month. We have to talk about it because it's in the headlines and it drives short-term fluctuations. But, if I'm focused on my 401k and saving and doing what I need to do and keep getting my house right and getting my budget right, you don't need to be worrying about anything that these people do or say. All you need to do is look at the chart of any index over the last 80 years and pick a time that it was a bad time to get started. And it's going to be you can't.
Yeah, I mean that's the long view. That's the
long view.
That's the long view. Yeah,
yeah. That's the long view. But we are going to be paying attention to it, and it'll be interesting to see because you do have that comparison to Greenspan, which I did in fact predict before, like 2 days before, and then the headlines started coming. That there are certain periods of time where the Fed goes from being a gatekeeper or a control mechanism to the speed of economic growth to being a tailwind and a support structure. Greenspan really was that. And if that shift starts to really become true, really materializes to where we have a Greenspan-like approach, like we had in the 90s, that flips it to where, it's it's very interesting to pay attention to because it could have a structural impact over the next 10 to 15 years that's hard to ignore. But we'll watch the press conference. We'll get back to you.
Yeah.
We'll filter it all through. I'm not going to promise I'm going to watch all of it.
You have to. It's your duty. I want a 3-page report on what he says.
Yeah, we'll have a breakdown for you next week. We will.
Well, let's move on into the planning room. We talked about all this kind of concentration and the rallies within that certain specific sector and then the pullbacks in the sector. So all this kind of goes into the question of, or the conversation rather, of what do you do when you look around and see, you're going to feel really good about the 8 or 9 weeks of positive gains that we had, but then you're going to feel really, 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 really bad about the 1 week of negative returns or the possibly 2 weeks of flat or negative returns. That's when your wheels start turning and you start thinking, oh, there's something wrong here. Is that the right way to frame that conversation? Yeah,
I think it is the right way to frame it. And you're looking at, you can't overweight 1 week's experience. You can't, that's not healthy. If you're doing that, stop looking at the account. Shift to a quarterly strategy of reviewing your 401k and your IRA. Don't go to a daily. The market understands the emotional investor. They understand you more than you understand yourself. The algorithms understand it, especially now with AI powering a lot of the algorithmic trading, which is significant. I would argue, we don't know for sure, but I would argue the overwhelming majority of daily trading is done by computers and not humans anymore. They understand human behavior, and they are willing to put their money where that understanding is in order to exploit you and take advantage of you so they can get wealthier and not you. So when you see things go down and you have that emotional response, you have to understand that emotional response was predicted and understood before you had it. And now that you have it, if you act on it, you're going to be on the losing end of that trade. So I think what you said is exactly right. You want to look at weeks and weeks of good performance, structurally sound expansion of the bull market, and then when you have one down week, ignore it. Ignore it. That's the best way to go about doing it. And successful investors and people that's been in their 401k for a long time, they have that experience and they know. They know that that you're going to have your ups and downs and you stick with it and you're going to keep winning in the long run. It's more for your people that are really kind of in that building phase that have not experienced a lot of the volatility, or maybe they did, but they were not able to contribute enough to get their balance built up to where those swings mattered more. When they were at 100 grand, it didn't really matter to see a 10% pullback. But now that they're at 300 grand, they feel they even though it's the same percentage, the dollar amount's greater, and you feel like more is happening, even though it's the same thing. And that's just something that takes discipline and practice to understand. But you want to keep that same approach when you were building it from 50 to 100 grand that you have when you're building it from 300 grand to 500 grand. Okay, the numbers on the screen have no emotion. It's the same percentage movements from 50 to 100. So you want to keep that balanced and in perspective when you're looking at, I'm up and I'm down and then I'm really up and then I had a pullback and then what does that mean?
You may also have people looking at it from the standpoint that they have been in that accumulation or saving or building phase and they had, a retirement in the last 2 years or something, and now they're not in that phase. And before they may have never looked at their 401k. They just put money in constantly. Now they're in the position where they have to make sure that they have income to come in, and they are. It is kind of worrying them. It's not something that they're adding to. So that sort of kind of creeps in there, which is understandable. It's human emotion. It's like you were saying.
It is, but you have to balance that with, as you built your balance up, your contributions were nil to nothing in a relative sense because you're limited in how much you can put in anyway into your 401k. So if you're at 800 grand, 700 grand, the most that you could put in on catch up is what, 30 grand?
Mm-hmm. Yeah,
right?
If you're working.
Yeah, so you're at 5%. So you can impact the balance by 5%, maybe. So...
Well, that goes back to the math or the math versus the behavioral side of it. That technical behavioral researchers call it loss aversion, which is that the loss feels on a grander scale than the gains did.
Yeah,
Nobody's doing reporting about, they talk about the market being up, but they're not having parties and pulling streamers and popping champagne. But as soon as the market starts tanking, they got that red alarm logo or whatever.
Yeah, you got to not pay attention to it. You got to have a plan and a process to execute. If you're rebuilding your portfolio from maybe heavier withdrawals, if you're rebuilding your portfolio from maybe an aggressive allocation that brought you to the downside, and or if you're just starting post-retirement from your 401k and now you're taking income and you're worried about rebuilding those income distributions, you just have to have a good, solid plan, and you have to let that plan work out, and you cannot worry about the day-to-day. And you have to understand that without volatility is the price you pay for returns, and that volatility can come in a myriad of ways. It's either in your account, or the volatility is in how much you're able to save. It's maybe in job promotions or job losses. There is volatility that's going to occur, but that's the price you have to pay in order to build and compound wealth. And you have to be disciplined about ignoring those down periods, because you want that to lead to constructive things, not destructive things. And so you're exactly right. It is human, but that's why when you're feeling that way, you have those concerns, you need to reach out to somebody and talk to a professional, a trusted advisor that you can walk you through, and they can either validate or invalidate those concerns, or figure out a structure and a path forward for you to not worry about those.
Well, I think a simplified framework of that is when your portfolio drops, ask yourself a simple question, like, has anything about my long-term plan actually changed? That sort of speaks volumes. If it hasn't, then you're probably okay to just sit by and not do anything. And of course, we're talking about short-term volatility here. We're not talking about prolonged, multi-month to years-long bear markets. But if on the flip side you answer, yes, something has changed. I retired in the last year, or I had a new kid, or I've got my spending is cut, or my spouse lost a job, whatever happened. If there was something that changed, maybe it's worth reconsidering. Maybe it's worth looking at maybe some kind of option that you can take. So, I mean, there's not it isn't one size for sure.
Yeah. And we have had a client recently that we did a small reallocation on because of the shorter time frame to retirement, and wanting to have a little bit more of a cushion should there be an opportunity open up in other positions, or just because that time frame to retirement is getting compressed. And that is a framework, and that's a way you want to look at it in, okay, like you said, what are my goals, or have my time frame changed? And if there's a compression that occurs, then it can be very reasonable to thoughtfully make portfolio changes so that you can account for these things, and then make sure you're in the right emotional state leading up to that new shorter time frame in retirement.
Right.
And what that means, and if you have expenses that I'm retiring, but my retirement is also lining up with certain expenditures, so I need to make sure I have that guaranteed amount, call it 5, 10, or 15% of cash, in order to execute on that without affecting my long-term goals on everything else.
Right.
So that's right. That's why having these discussions can bring that out. But just on the high level, you want to always check when you have the emotion and you see down days and you start building that emotion of fear. You have to understand that other people are also doing that, and the market is going to take advantage of that. And that is why once you reach those periods in the market, some of the best market days on the upside are clustered right around the down days.
Yeah.
And it's because they can crescendo that emotional selling, and then boom, it goes up.
Yeah. And from an investment standpoint, when you have these pullbacks, a lot of times they can introduce some opportunity. So if you are not somebody who does rebalances frequently or on a certain schedule, maybe a good time to look at a rebalance of your portfolio when the market, has a little downturn. If you're somebody that makes use of Roth conversions, very good argument to be made to have a Roth conversion in a downturn, because you get, that discount sort of that conversion, and then the value will kind of recover when the market does. So there's a lot of opportunities as well. Again, reach out to a professional to kind of walk you through this if you have these questions. But there are a lot of opportunities to be had with it. It's not all negative.
And technical and volatility guardrails with a disciplined approach can play a really good role in raising cash in uncertain periods of time, and then using that volatility to redeploy cash. Sometimes that's paired with momentum-driven allocations, and that can be a really powerful tool for peace of mind. And it's not the abandonment of any investment strategy. It's part of the investment strategy to where you introduce timing risk as an alpha generator. Sometimes that's appropriate. It's not appropriate all the time. Sometimes it is appropriate. And that's where, again, what type of portfolio are you in? What type of plan, and what's our strategy? There's a lot of very large institutions and large funds that use volatility driven guardrails to allow for cash raising in volatile periods to again generate excess return later. It's not a 100% winning strategy. Definitely would be something that you don't want to do on your own. But it is a tool that can be used to bring that peace of mind, but without changing your long-term strategy. And so every market's different. Every strategy can be different. There are ways that you can help solve for that emotional kind of turmoil of seeing down days when they happen, or prolonged down periods when they happen. And I just always encourage people to reach out, especially if you don't have an advisor, because talking through the strategy and the plan and knowing, okay, my strategy actually does get a little defensive, or maybe it's already defensive, or my strategy is not agnostic to increasing cash levels as an alpha generator, which is something that, I know we weren't talking about this, but it's just bringing it up. It's something most people never think about is, we at our firm and other firms that are like us, have that ability to actually, use cash as an alpha generator in the right moments, in the right times. But it's a part of a strategy. It's not a response mechanism. It's a part of a proven mathematical strategy where we believe the odds are in your favor if that were to occur. So I don't know. The simple answer is, understand your plan. It kind of goes back to what we were talking about, at the beginning of the show. You understand what you need in your plan and what your target is and what your pain thresholds are. Communicate that effectively with your trusted advisor and see if they have a strategy and a plan that comports with that.
Yep.
And if all those boxes align, and if your pain thresholds are high, then don't worry about it. If your pain thresholds are lower, then communicate that with your advisor, and they can help structure a plan to say, hey, we have cash raising guardrails. We have volatility guardrails. That's actually going to work to your benefit. It's going to be in alignment with your risk tolerance, and it's going to be in alignment with that 10% compounded return that you need, not the 13% that your neighbor got in Apple or 20% they got in NVIDIA over the last 18 months. It's the 10% you need. And as long as all those things line up, then you don't have to worry. You just let the process play out.
Yeah. Also kind of my mind just went blank. It's a good reason to do several check-ins of a risk tolerance over cycles, especially market cycles, because you tend to be a little more optimistic with your own risk tolerance in bull markets. When the market is going high, you want to be as aggressive as possible. As soon as that flips, you don't want to be aggressive as possible. So it's really hard to get the true risk tolerance, but it needs to be done over several market cycles. But it's a good opportunity to kind of check that, like you were saying, check your risk tolerance when there's a pullback. Can you still sustain it? Is it gonna put off alarms in your head or whatever? Are you invested as you should be invested? But
yeah, and then what is your advisor doing to, as markets change, whether it's rebalancing, if drift over, say, a 5% drift has occurred on position, is that being brought back down into target? Are you buying into weakness, selling into strength? And then also, is your advisor, looking for opportunities to become defensive when things are frothy? Are they looking to help solve for 2008 type scenarios, but still keep your risk tolerance where it's at?
Right.
And those things are complex. And
specific to your situation.
Exactly. Yeah. Specific to your exact situation. Correct. But, to wrap here, that was great. I think it's a great conversation, and it's honest, and that's what you're going to get from us. You're not going to get fluff. You're not going to get sales type stuff. We're just being honest with you, because that's what this is. We have strategies that we believe work, and they do work. We've watched it time and time again through up and down markets. We've watched hit these targets return averages that meet or exceed the client's stated return need.
But we also have genuine conversations with clients every day of the week. And so the idea behind this particular part of the podcast, the planning room, is to kind of give those some space because other people might have the question.
That's right.
So it's a natural conversation that really happens. And we take that and we say, how can we use this information to, have this conversation with as many people as we can that you're already having internally anyway. When you open your
just to be honest about it. That hits the nail on the head because my whole point is we have strategies that we do that kind of touch on all of these topics. They touch on these topics because these topics are emotionally important and a real part of your retirement.
Right.
The way you feel in up and down markets is a real part, and we want to have strategies that address those in a reasonable and responsible way. That helps keep you in the strategy and helps keep you on target. And all this stuff is a part of that, like you said. And it's just, it's the honest take. And nothing is always, sunshine, rainbow, and butterflies. But when you zoom out far enough, right, even the storms look, the most damaging hurricane looks beautiful. When you go and you zoom out far enough and you look and it's like, wow, look at the structure, look at the organization of that storm, look at just how incredible it is. In the eye of the storm, it doesn't feel fun, which we're not in.
I was about to say, we're not in the eye of the storm.
We're not anywhere near that. But if you think back to 2022, you think back to March of 2020, you think back to December 2018, you think back to the oil collapse in 2014, 2015, when it feels like you're in the outstretch, if you zoom out far enough, it's fine. And that's what we're here to do. We're here to zoom you in a little bit and then immediately zoom you right back down. So it's like that plane that flies through the hurricane, right?
I don't know. I've never been on one of those.
Can you ride one? I don't think they let you on them.
Anyway, that seems like as good a part as any to wrap it up on. We got a rotation happening sort of in real time. Core inflation, it's actually sort of behaving. Labor market that's healthy. Picture is a lot more constructive than maybe the headlines would suggest. That's the basic takeaway for this week's conversation.
Yeah, and we'll be back next week, of course. Any questions you have, always feel free to reach out to us. MomentumWealth.us. We're here as a resource for you. If you're not a client, give us a call. We're not going to sell you on anything. We'll be here to help you, guide you. If we're a good fit, that's great. But if not, we wish you the absolute best of luck and we'll help give you something to think about. But that's good returns. Thanks for spending time with us.
Yeah, subscribe if you haven't. We'll see you back here next week.
Yeah, take care.
Bye.